this is really about, or it's framed in the context of startups who are looking to raise money. So what do you need to know about giving away equity? What should you consider before you start thinking about fundraising? And we've got an expert panel with us, and we're very grateful to have them. So I'm going to ask Russell, if you could go first, just a minute or two to introduce yourself, your expertise, your successes, whatever you think might be relevant. Then we'll go into the other panel members, and then we'll dive into the really interesting bit of the questions.
Thanks, Sam. It's always terrifying to go first. Hi, everybody. My name is Russell Copley. I am the managing director of a company called Greenborough Management. We kind of started life as a project management and business development consultancy, but we seem to have morphed into a business that spends a lot of time dealing with access to finance and investment readiness agenda. We currently run 3 accelerators under a brand called 10 by 10. So we've got 3 business accelerators running across the country in Q1 2021. We've been running the investment readiness program in Lincolnshire for 8 years now, and yesterday started our pilot program for investment readiness workshops in Leicester and Leicestershire. I have been for 9 years the regional manager for Angel's Den as part of a portfolio. So I've been involved in new start business funding, gosh, since before I had grey hair and since before lockdown 1. I'm also an investor, but only a modest investor because I'm not that rich in early stage businesses. I've got 2 active current investments in other businesses, as well as 3 businesses of my own. And it's great to be here.
Thank you, Russell. Victoria, can I pick on you next, please?
Of course, sorry, I just forgot to take my mute off again. So I'm Victoria Copestake, and I'm the operations manager at First Enterprise Loans. We're a not-for-profit organisation, and we are a responsible finance provider. So what that means is we offer finance, government-backed finance, to businesses and individuals looking to start a business across the East and South East Midlands. We run the Startup Loans programme, and we also offer funds through the Midlands Engine Investment Fund and also Big Society Capital. So we're able to help anybody looking to start a business right from that pre-start stage all the way through to existing businesses. I think the oldest business that I can remember we've helped have been running a very short 99 years. I think the original director was still in the cupboard there. But so exactly. Startup businesses and existing businesses, we can help at any stage of the programme with finance of up to £150,000 to £200,000.
Great, that's excellent. Sandy, can I pick on you next, please?
So I'm Sandy Reid. I work at Mercia Asset Management. We have about 800 million of assets under management. We pride ourselves on being regional investors, so we tend not to invest in London and the South East. I'm the lead for the East Midlands, which is why I've been invited to come along today. We have both debt and equity products that we can put into companies. Obviously, I'll be talking about equity today. We can fund businesses from startups, so sort of 100k round size, all the way through to about Series B. So for the right business on the right journey, we can use the funds that we have under management, probably take them up to about 10 million of investment. The main fund that I'd be using when I'm looking at startups in the Leicester region is the Midlands Engine Investment Fund that we have under management. We look after the early stage fund, which can do 100 to 750k into any one business. But as I said, we've got a variety of funds under management. So as the company grows, and hopefully it's on the right growth trajectory, we could use our EIS funds alongside that. We've got VCT funds, and we have our own balance sheet as well.
Thank you very much, Sandy. Locky, last but by no means least, could you just give us a brief intro, please?
So, hi guys, I'm Locky. I'm a final year management student at Warwick, and I'm an investment analyst at Create Fund. So Create Fund is a student-focused VC fund where we invest in early stage students, academics or recent graduates. So we put recent graduate around 2 years, and it's based off the popular dorm room fund model in America, which is the third most active VC fund in America, where they have different analysts and investment partners at all the best universities who source the deals, for investment. We invest anywhere between 50 to 150k, all technical businesses. So yeah, I think I'm probably one of the newest to this space, but it's very good to be here, and hopefully I can help out.
Thank you very much, and you're very welcome. So thank you all to all 4 panel members. Just as a refresher, particularly if you've just joined us, we're using the platform Noonie. The link's in the chat. So this is an interactive session, it's roundtable, and this is your opportunity to speak to 4 subject matter experts. We've already got 2 questions, so I'll start with one of those in a moment. But if you want to ask a question, or if you particularly like a question, you can upvote it. Mindful, we've got 47-ish minutes left, so we'll try and get through all of them if possible. But of course, that's what the upvoting is for. If you like something, we can prioritise it. So I think if I click on it, I'll highlight it. Right. You, to the 4 panel members, you don't all have to chip in. If you think actually something here is not quite relevant for me, you can let the others talk. But this is the first question that's come up. So what are they trying to say? I don't know if any one of you 4 want to jump in, or if I can think of a better beta test. Anything there that stands out to the 4 panel members? Second.
I'm happy to start on this one because it's a subject that comes up in every single deal and every single conversation, which is around valuation. And I think understanding how investors reach their views on valuation, and understanding how you're going to interact with that investor. So as an institution, I'm not investing my money, I'm investing clients' money. And even at an early stage seed round, I will be thinking about what return I'm going to. That will include modelling through the subsequent rounds of investment I think are likely that a business is going to need. And so once you work that back, you can then get a view on what you measure. Now, it's a transaction. So if an entrepreneur doesn't like the valuation that's being put forward by an investor, then that's absolutely fine. And they may be able to raise their investment at that price with somebody else. And that does happen. So, you know, it's never the entrepreneur sets the valuation or the investor sets the valuation. It's a mutually agreed position where from our side, we feel that we're getting the benefit of taking the risk early in a business and being able to maximize the return at a later point for our clients. So it's always going to be part of a debate. Now, there are numerous ways of doing valuations, but at early stage, particularly pre-revenue, a lot of them fly out the window. Using DCF, for example, in a pre-revenue business is, in my view, a bit of a nonsense because, you know, you're making up the forecast, so therefore you're making up your DCF model. So we tend to look at benchmarks that we've used in other deals or that might be around in the community, you know, what we've seen in other deals, but we also balance that with looking at the likely multiples you're going to get at the exit point and working that back. So it's not just one or the other. So I think there should always be a discussion with entrepreneurs, and it's always going to be the case that we think valuations are lower and entrepreneurs think valuations are higher, but hopefully you can reach a middle ground in between.
I'm going to just build on some of the stuff that Sandy says there. We have a lot of people that come to us that have been sent away from equity investors simply because what they want, first of all, is them to look at proving the marketplace. And it would actually strengthen then the valuation of the business. So we've helped a lot of businesses but take up debt finance through the startup loan. It is a loan, it's not a grant, it's not equity investment, but it has enabled them to go away and get a better deal with investors because they've been able to go and try the market out, get those first few sales under the belts, and has been able to then prove to the investors that they've got a saleable product or service.
If I could also pitch in on that as well, from my own experience, often early stage entrepreneurs will come to us and they have quite a flashy valuation that they've spoken to other people, maybe the business advisors, and this is what they've come up with. But certainly from a VC standpoint, you need to absolutely make sure that whatever money you put in, the business is going to make tangible improvements to the business for the next round. Otherwise, you'll face double dilution. So that also plays off what Sandy was saying about how we often want it to be a bit lower. The entrepreneurs want it a bit higher. But really, it suits everybody if you can make these constant improvements to the valuation with each increasing round. So it can make a lot more sense to lower it a little bit initially, get further traction, then raise a higher round, and just sort of continue on that cycle.
I promise I'm not going to, you're not going to get 4 answers to every single question. You certainly won't get an answer from me from every single question. But as somebody who sits in the middle, somewhere between the entrepreneur and the investor, valuation's a very emotive subject, particularly with founder creators of their little babies. And I think two things to say. For pre-revenue businesses, valuation is an art, it's not a science. There are 13 different ways an accountant will tell you that you can value a pre-revenue business or a pre-significant revenue business. And the ultimate answer is something is worth what somebody is prepared to sell it for and what somebody is prepared to pay for it. I could tell you that my house that I'm sitting in now is worth £1 million. It's not, but I could tell you its value is £1 million. It's only worth £1 million if someone will pay £1 million. And I think the second thing to say is turn the telescope around the other way. Don't look at what your business is worth now. Look at what it's going to be worth post-investment in 4 or 5 years' time. And if you've got 60% of a very big cake, that's better than 100% of a small cupcake. And that's the kind of emotional mindset that I spend a lot of my time trying to get in entrepreneurs, early stage business people to get their heads around.
I think I'd just follow up with one final point on valuation. One of the things that we see in the early stage part of the market, we're often the first institution investing. And what we'll have maybe seen is angel rounds that come before. Now, angels, I find, generally are quite valuation insensitive. They don't necessarily go through the modelling and the thought process that an institution does. And so may accept the valuation that's proposed by an entrepreneur, and that's fine, and you will feel that you've got a good deal. The challenge then becomes when you want to continue scaling your business and an institution arrives with their viewpoints on valuation, and you have a very difficult scenario where it could be a down round. And you've then got to balance between your existing shareholder base not being very happy at a down round, combined with maybe their lack of ability to follow on to subsequent rounds as you scale the business. And we've seen in the last 12 months a lot of down rounds going on because angels have not been able to support all of their portfolio during the pandemic, and valuations were on a real bubble just before the pandemic kicked in. And so there's been some really difficult conversations where we're just not willing to pay even a flat round on the last round because we felt the valuations are very overblown.
Right, so next up, and incidentally, we haven't got any questions after this. I've got some questions, but it would be great to hear from the audience. I know that's what we're trying to make this session interactive. So what is the best way of matching a company looking for investment with the most appropriate private investor, PE investor, based on their requirements criteria? So any thoughts from the panel on that?
Again, I'm happy to jump in. I think it's probably most pertinent to my background. So if you look at the BVCA website, you can get a complete list of all the investors that are out there. You might then have a bit of a task because you've got to go and look at each individual investor's website, but we are all very open about what we're looking for, what stage of business, how much we'll invest, what active funds we've got. So you can do your own desktop research and actually find answers to that. So there's no point in approaching somebody who doesn't invest in your sector. So I'll give you a really good example. At Mercia, we don't tend to do B2C, retail, those types of activities, hospitality. They're just not spaces that we invest in. So if you've got a business in one of those spaces, you'll be wasting your time and our time if you try and pursue investment from us. So you can find most of that on investors' websites. The other place is to talk to the community and talk to the people around you. Who have they liked working with? Who have they got investment from? Who would they recommend? Because I think other entrepreneurs will give you a very clear picture of who's good to work with, who's bad to work with, what sort of businesses that they like. And the final part of this is, if you have a good board in your business, then you can use that network, and a good chairman, for example, should know who you can go and talk to, who would be good investors for your sector.
Yeah, Sandy's put it very eloquently, and Sandy being at that end of the spectrum is probably giving the best answer that any of us could give.
Great. Okay. Questions are starting to come in now. Great. Okay. So the next one's about COVID. To what degree is COVID still an issue, and to what extent? And so what does Q1 and Q2, how is Q1 of this year different from Q2 of 2020? So, yeah.
I can start this one from a business angel perspective and some of the angel groups that we do some work with. Q1 2021 is a little different to Q2 2020. That's an interesting dynamic. So we're kind of comparing apples and pears a little bit. I think the angel community have got used to Zoom. They've got used to technology. If you go back 12, 18 months, business angels don't invest in things they don't see the whites of the eyes of. And actually, being able to interrogate, grill, get to know an entrepreneur, get to understand their personality. I think one thing that COVID has given us is the opportunity to get those that personality, that engagement across a whole lot better through technology than we used to be able to do. You go back 2 years, nobody would ever invest in somebody they'd never met before. But it is now happening. The difficulty is that peer engagement, that syndication, whether that's formal or loose syndication. Quite often investors will club together with their mates, and maintaining that collegiate approach has been quite difficult, even with the technology. Zoom has its limitations, Teams has its limitations. I think probably we need a new technology specifically for this type of engagement that enables investors to chat offline with each other whilst the entrepreneur is still in the virtual room, but without the entrepreneur hearing. But it's different, but we're getting better.
I think what we've seen is actually
on the point around angel investing specifically, we've seen
Sandy,
I think I'm on a lag. Let me leave and rejoin.
Okay, I'll fill then. So I was going to say, so it's Victoria again from First Enterprise Loans. We have seen a real ramp up of activity of people inquiring for startup loans because of wanting to start their own businesses and be able to do something different and work from home and have that much more flexibility. So the appetite for tech startups and entrepreneurs wanting to do things a little bit differently. We have seen a massive growth this financial year since perhaps building into the new year, new start. And then also we have seen a steady continued interest in the CBILS programme. Don't forget that at the moment the CBILS, the Coronavirus Business Interruption Scheme, is planned to end at the end of March. And we're seeing a flurry of activity of businesses where they've had the bounce back loans and they've made them stretch till Christmas, but then we've had this third lockdown, and actually now they need the injection of cash to be able to keep things going, to keep diversifying, to allow them to continue to trade to get through to the spring. So we've seen two ends of the scale. The existing businesses needing that extra support to keep trading with the CBILS funds, and then also the flurry of activity of new entrepreneurs wanting to start their businesses and wanting to do things perhaps slightly differently, slightly more flexibly, and a massive increase in the applications for the startup loans programme.
Thank you, Victoria. Sandy, I don't know if you're back with us.
Yeah, hopefully. I think I was on a bit of a time lag. That's okay. So a couple of points. So specific to Russell's points about angel investing, we're seeing that specific angels might still be active, but in general across the market, there is a lot less EIS money at the moment coming through. That hopefully will change over time. The second point more generally about sectors is there's winners and losers due to COVID. And in the sectors that are losers, so anything associated with travel or hospitality, The challenge at the startup phase is, if you're a startup investor, an early stage investor, do you put your money in now and say they'll burn through cash whilst there is uncertainty, or would you rather invest once there's more certainty in the market? And I think that's the challenge facing investors in some of the sectors that have been most badly hit by the pandemic and lockdowns, is trying to make the decision of when to invest. Because I don't think there's any doubt things like hospitality and travel will rebound and will be good active sectors. But what's the point at which you would want to make an investment there? Because the worst thing you can do at an early stage with a limited cash runway is put the investment money in, see it used up when there's no market to be had, and then when the market's rebounding, you're out of cash and you need to recapitalize the business.
I think Sam might have been kicked.
Yes, I think we may have lost the host again. So, Russell, you're always good for filling time in the nicest possible sense. Is there anything that, top tips that perhaps you could share with people moving forward to, if they're looking to attract investment, finance for a startup business? What could you recommend they'd look at?
Oh, thanks for the spotlight, Victoria.
Sorry,
tip,
Russell.
Top tip number 1: don't support Nottingham Forest. Top tip
I don't,
and
Russell.
I do
I
and
don't.
have done for life, unfortunately. Top tip number 2: if you're looking for investment, develop a really thick skin. You've got to kiss a lot of frogs in this world, and timing is critical. So you might have the best business, the best project, the best investment proposition, but if it's not right for your funder at the time, particularly talking about business angels rather than institutional funds, if you think a typical business angel has probably got 5 investments in his hand at any one time, and he'll try and exit one of those annually every year and then recycle and rechurn that money. If you don't catch him at the right time, he may not be able, even if he was willing, to invest at the stage that you're after the money. So I think, it's not a top tip, it's common sense, but common sense isn't very common in my experience. Develop a resilience, develop a thick skin, learn not to get offended by no, take feedback, listen to people like me, Victoria, Locky and Sandy, and we'll each have a different perspective, but we're each coming at it from the perspective that we want you to get the funding you need. But just be prepared to ask and ask and ask again. The more people who know that you're looking for funding, the more likelihood you are of getting it. We're very hesitant, we're very reticent in this country to go out and ask the people we know. I'm looking to raise 50 grand for my startup. We kind of do it apologetically. We do it with our hand over our mouth because money is an embarrassing subject in British culture. It's a dirty word. And you go to America and it's completely the opposite. You're talking about investment in the locker room. You're talking about investment in the bar. You're talking about investment on the golf course. You're talking about investment wherever. So, yeah, kiss a lot of frogs. There we go. Top tip today. And hopefully Sam's come back.
Yeah. I came back to kissing lots of frogs. So I'm not sure what I've missed. Sorry, folks. It keeps dropping out. So is that the COVID question? Yeah. Okay. So next up, we've got innovation-led startups, in particular, originating from the universities, often require 50 to 100K to bring their concept to market or to a sufficient TRL to raise for fund. So this is there's a question around here.
You sound
often gets referred to as crikey. Right. Okay. I'll shut up. Could someone read the question and answer it, please?
Yeah, I'll read the question because I suspect that Tim Maskell, is this your question? You've clearly not named yourself, but my guess is, having had multiple conversations with you, this is a Tim Maskell question. So I'll read the question for those who can't read it, and then I'll give you a perspective. So innovation-led startups,
get you nowhere, Russell.
in particular originating from the universities, often require 50 to 100 grand to bring their concept to market, or to a sufficient TRL, which I think is technology readiness level, which is why I think it's Tim, to follow on funds. Local grant and loan providers will traditionally fund between 1,000 and 20 grand, you wish, although usually with specific and strict criteria. How can we work together to address this consistent issue or chasm of this funding, which ultimately prevents strong innovation-led businesses being developed across the region? Well, I think I'll give you two very quick answers, Tim, and then I'll pass over to Locky, who actually has probably got a more sensible answer. The first answer is actually, and you and I, Tim, have been in this world for donkey's years of universities and tech transfer and spin-outs. Universities actually need to put their money where their mouths are. Having a university fund that'll be able to do things like that is great. But collective universities, the three universities in Leicestershire, spin out a lot of intellectual property-based academic startups and also support a huge amount of graduate startups. Why not the universities co-investing in a fund with one of the fund managers or the LEP or the county council or the city council, and provide a fund through which those kind of entities could bin into? And the second answer is creator, isn't it, Locky?
Yeah, hopefully. I mean, that's kind of what we're here for. So, yeah, I would say actually, I think the government as a whole is actually sort of noticing this and trying to get on this a lot more. So you've got organisations like Innovate UK, Knowledge Transfer Network, Cyber ASAP, and lots of different sort of separate bodies where they're basically working to pump equity-free cash into these genuinely very, very exciting innovations that are often spinning out from universities. So with this, something like Innovate UK tends to have match funding from private equity. So it'll be on the grounds of you have to get private investment, which is why we come in for that. There's other programs like iCure, which is pretty cool, where they send them an academic out to speak to like 90 customers or rival competitors, things like that. They collate all that advice on their particular innovation, come back, and then they basically pitch based off the advice they've got, whether it's worth sort of spinning out and making it a commercial entity. So I think there is actually quite a lot of avenues people can pursue now in terms of getting like loan money, but they have to have sort of, to be able to walk the walk, they have to have a genuinely very exciting innovation behind them. There's also things like obviously Creative Fund now with the, I guess, private investment side. So this is like exactly what we're looking at. But I also think there's a massive role to play for the university themselves. So Warwick is, like, they'd hate me for saying this, but Warwick is really bad at this in that we try and take 50% of the IP, which absolutely kills the company. It makes it super unattractive for investors. And so it's really difficult to get a Warwick spin out private investment. The average across the country is around 22%. So usually the university takes 20 to 25% in a spin out, but that's enough where a private company come in. So I think the biggest challenge really is there's Warwick, and I think Nottingham is the other one that tries to take 50%. That in itself is a massive challenge. I think the other big challenge is where capital kind of gets circulated. So London and Oxbridge is like takes like obviously by far the majority of private equity. So it's nice when universities sort of outside of that sphere get onto these programs and then can sort of get noticed by private investors like Creative Fund. I think that kind of answers the question. So I hope I haven't gone on too much of a tangent. But yeah, I think it is getting better, but you need a lot of university cooperation with private investors. Or like Russell was saying, if they were to have their own fund, that could also work. Although obviously I'll be a bit biased to Creative Fund.
Can I interject there then? We have at First Enterprise and Enterprise Loans, we have the funds. They are loan funds, but we have the startup loan fund that can be up to £25,000 per director to maximum £100,000 per business to do exactly this, to prove that concept, to prove that marketplace, to be able to go away and go and get equity to grow the business further. And we have countless case studies of where we've been able to help businesses very much like this go through the journey of getting the investment. And I think you do have to, when you're starting out, you do have to plan your steps in your journey, and you are going to have to sometimes put some skin in the game yourself and take some of that loan funding there. All our loans can be used as match for grants. So quite often the grants are used, were funded up to about 30%, 25-30% of the actual spend profiled. So all our grants can be used to match that and fill that gap. And it's a real good, particularly the startup loan, it's a really good first step on the journey for getting the investment that you need to be able to show and prove the concept to the business. Then within the Midlands engine, you've got Sandy with the proof of concept, but you've also got our other part, the small business loans. That can be used again for startup and growing businesses, and that's up to 150,000 there. And those two can actually be patchworked together. So potentially you can get £250,000 of loan funding for early stage businesses to do exactly what you're looking here, matching grants and proving your concept and really showing the marketplace. So it is out there, but you have got to potentially accept that it's loans rather than grants.
Russell, I wanted to jump in. So sorry, Pete Hitchings. I've got two hats. So one is part of Leicester Startups, and one is incubator manager at Loughborough University. And I had to jump in to save Tim because he was just getting pounded for the question that I posed. So I realised it was yours.
It had to be one of the two of you with a university background.
Yeah, and I just wanted to say thank you for that, and I'm also taking the opportunity, given that Sam is dipping in and out technically. I think one of the challenges for us is that we have a lot of potential alum who are interested in investing in entrepreneurs, but there's a big gap in this area. And I appreciate the kind of suggestion that universities should, and in some cases do, provide some of this support through some of the ICA and other activities, but they are not always easy routes to go down, and not always appropriate for some of the businesses. And I actually personally believe that we're missing out on a big chunk of potential investable businesses by not having something that kind of responds in a more simple way to this. But I'll leave it at that, and perhaps pick up separately. But thanks for the responses; it's really helpful.
Thanks, Pete, for jumping in. I'm not sure if folks can hear me. I'm in a different part of the house. Does anyone, Sandy, any thoughts on this, or do you think we've nailed this one down there? Right, okay. Russell, the top questions.
I think this one's been covered really well by the rest of the guys there.
Great.
This question, Sam's clearly aimed at me because it's got my name on it.
Yeah.
I'm having issues as well. It's not just you. I'm going to leave and join again, my last attempt.
Thank you.
All right, we'll see you in a bit, Sandy. So yes, I previously said that founders shouldn't say giving away equity. Is it semantics, or does it turn investors off? Do we need to change our language? It's not so much a language thing, although it is a language thing. That the concept of giving away equity, I'm not giving away a slice of my cake to you, nasty investor. It does turn investors off. It's not just semantics. It's much more around mindset. The mindset, if you approach equity investment as I am selling 20, 30, whatever % of my business in exchange for your cash, you mentally approach that process in a much more logical, dispassionate, professional, business-like approach. If you go into the negotiation or the discussion saying, no, it's mine, it's my baby, this is my little cupcake I've created, I'm the inventor, I own it all, and I'm not giving you a piece of it, you set the tone for the discussion, you set the tone for the negotiation that does actually turn investors off. If you go into it in approaching it as a sale, as you would a product sale or as a service sale, I have something of value and you want it, so let's negotiate what that value is worth. Let's negotiate a price. Let's negotiate what else you can bring to the party over and above cash in terms of leverage, little black books, contacts, know-how, experience, expertise. Then I think you change your whole approach and your whole mindset. So it is a big bugbear of mine. I should have told Sam off at the very, very start, because as part of his intro, he actually used the phrase giving away equity. Yeah, thank you for whoever asked the question. I will get off my soapbox now and let someone else chip in if they want to.
Hopefully my signal's back now.
We can hear you.
Yeah, good. Sorry, I wasn't sure. Yeah, as an investor, I'm mixed on this one. It's a phrase I hear and it's just slipped into language to one degree, so you can ignore it. To Russell's point, the thing that bugs is when it's used in exactly the way that Russell described. With that, it comes with a layer of we just want your money, we don't want you to be involved in the business, this is all my business. You know, that whole attitude that goes behind that, what it tends to signal is a degree of naivety and somebody who's not used to working with institutional investors, and so that can be a turn off. So it's not the specific wording itself, we hear it often enough to know, but it's if it's played along with a mindset that really views it that way as a genuine case. I mean, I think I've even heard institutional investors use the phrase giving away equity, not that often, mind, but I have heard it. So it's about the whole approach, and it goes exactly to the heart of what Russell said. A big turn off is somebody coming in just, you know, wanting the money, wanting a very high valuation, not considering why the institutional investor would be wanting to be involved with a business. You know, because we're not just dropping cash and walking off. That's not how we operate, certainly at Mercia.
Thank you, Sandy. Locky, I think Victoria, perhaps we have nailed this one down. It's yeah, you've mentioned this before, actually, Russell, and I think this talks to the point about preparing for pitching as well, and I don't know, positioning yourself in a respectful way, and just that one sentence that I used, "Were I pitching to you," could have potentially thrown the whole deal away. So yeah, I guess this might talk to the point around really preparing and practicing your pitch and or your presentation to ensure that you sense check it with other people to ensure you're not saying something silly, as I just did in my intro. Right, next up we've got this one. At what point does an enthusiastic, fun, lean startup need to have a serious talk with itself, and what should it say? Any takers?
How are you going to make money? Because it's a little bit of a lot of focus can go in an early stage fun lean startup. A lot of focus goes on the tech, and we find a lot of people with tech experience building products. But building the most fantastic product in the world does not sell itself. And having a very structured and disciplined commercial and marketing and sales operation around a good product is what actually makes you money. So if you're a fun, lean startup and you've been going a while and you're not making any money, that's the point at which to have a serious conversation with yourself and say, how am I going to make money?
Russell, Sandy, or Locky? Any thoughts on that one?
I'll just add in and say, sort of following on from what Sandy said, I don't think it needs to be like mutually exclusive though. You can stay lean, you can stay fun, like you can set your own culture in your startup and still make sure that you are like generating the revenues you need to. So I think that's quite a hard question to answer in terms of, I think it's quite like a case by case basis sort of question. If you are at the stage where you've been operating for a while and you've got the culture nailed, but like Sandy said, you're not really turning a profit, then okay, that's cause for concern. That's not going to last. But on the other end of it, I think the reason why people get into startups in the first place is because they are very passionate about the project. And there's no reason you can't be very passionate about a project, have a fun startup that operates in a very efficient, lean way. That also then makes a lot of money for whoever the founders are. So I think you can you don't necessarily have to have a serious talk if you're doing it right.
Yeah, and I think we've all referred to this earlier on, and Russell talked about it as well, was really you've got to have a plan of where you're going, and you've got to keep referring back to that. You know, I think I've said this is a journey to get the investment to grow the business, but you have got to sit down and put pen to paper or however you want to do it, and have a plan of where you want to go, where do you want to take this business, and keep referring back to that. And I know it's a really old school way of doing things, but the most successful businesses that we have seen come to us are the ones that have put that time aside and really had that journey planned out. At what stage are they going to need that finance? And they've left plenty of time rather than the 11th hour to come and talk to us about it. If you leave it to, I need the money tomorrow, no organisation in this forum or any of that I can think of that will get that funds to you that quickly. So you need to ask this question every day, but you need to start really early on with what are your aims and objectives for this? What's your plan? Where do you want to be? And what are you going to have to put in place to get there?
Perhaps there's also a conversation you need to have with yourself about, are you prepared to do the, grind out the 80 hours a week?
No. I think what you were trying to ask is, you've got to have a personal conversation with yourself as a founder as to what you're prepared to commit to. Any comments on that from anyone?
Yeah, I know a lot of fun businesses that started. Sorry, Locky. I know a lot of fun businesses who started lean, but they've got no massive growth aspirations. Really comfortable lifestyle businesses generating significant amounts of annual wealth for their business owner. And do you know what? There's absolutely nothing wrong with that. If you're not looking to grow massively, you're not looking for external equity investment, then why would you?
Thank you, Russell.
I was just going to say, I was going to go back to one of Victoria's points, and for the life of me, it's gone out my head. Yeah, it's gone. Sorry. Is Sam there?
I don't think I've ever been on a call with a host sort of subdued so much by technical faults. Not your fault.
Take over a bit, Pete. Come on, take over.
I'm just wondering, is there any other questions anyone's picked up from the list that we've got that anyone wants to grab?
I can do the one that's now highlighted. The most favourable qualities a business could have when being considered for.
Yeah, that would be helpful, Russell. Thanks.
So, I mean, you've heard me say this before, Pete. It's for us. It's understanding the business model. It's knowing how scalable you can be, how big you can get, and how quick you can get there. It's about the people. It's about how much you need and what you'll do with it, and how about the exit. But the fundamental, most important, the questions, it's relation to qualities, and that's personal qualities for me. That's enthusiasm, dynamism, credibility, commitment. If you're not enthusiastic and front foot and excited and passionate about your business, you haven't got a growth business. I don't care if you can't sell, if you're not the best salesperson in the world, but if you can't be front foot, positive, exciting, enthused about your business, then forget it. Credibility, it means different things at different stages in life. When you're my kids' age, credibility is I've done the market research, I've got some proof points in the market. When you're my age, it's I've earned these grey hairs, I've earned these battle scars, I've been there, seen it, done and done a few things. And commitment, it's about having skin in the game, financial skin in the game, but also emotional and psychological skin in the game. So if this all goes wrong, I am really, really going to suffer. I'll suffer financially, but I'll suffer emotionally. And you want to bring people into that journey with you. So in terms of qualities, the qualities actually rest as human qualities rather than business qualities.
Thanks, Russell. Anyone else like to share those kind of qualities and highlights for investable prospects and individuals?
I think, go on, Sandy. I'll go first if you don't mind. What we always look at is the strength of that management team as well. So, if you're on your own and you're starting up, we don't expect you to have teams of people out there that you're employing, but we do expect you to go away and get the resources and the support from organisations like ourselves, like yourselves, like the universities, like Russell, etc. There's a lot of support out there that will help you with your process of planning, help you get the best guidance. There's lots of mentoring out there. So whilst you may not have a massive management team that you can be funding and paying their wages for, you can go out there and get that advisory support and make sure in the early days that you've got the right people on board helping you grow the business.
Thanks, Victoria. Sandy?
Yeah, I completely concur with what Victoria said. management team, hugely important. We back individuals more than anything at all. The other thing that's perhaps a little, a bit more so is product market fit. Being able to demonstrate, particularly pre-revenue, some product market fit is the credibility part that Russell was talking about in some ways. You might have built your product, you've got this great tech idea, but have you field tested it? Tell me about the customers that you've spoken to. Who's doing a free trial? Who's going to be your case study? Who's going to buy it from you and why and at what price? Those are really critical things that are often missing. I've built this great tech product. Okay, who's used it? Well, nobody yet. We're waiting for investment to launch it. Well, no, you could be out there. You can, for free, you can talk to people. You can talk to customers and clients and start getting that feedback. It doesn't have to cost money.
Thanks, Andy. Yeah, I think just to share experience as well, one of the biggest things that we just have to keep reminding all the entrepreneurs that we work with is just go out and validate and test and, demonstrate that there's market. I read a book in the last couple of weeks called The Money Train by a guy called David Patterson. And one of the nice phrases that he used in there was, is there a kind of gap in the market and a market in the gap? Which I thought was a good way of putting it, to really dig into those opportunities. So Sam, if you're here, then feel free to jump in, but I'm going to jump to a question. I think we've kind of covered this, but I just wanted to...
Can
Sorry,
you hear me?
Sam.
We've got a customer development session at 2 o'clock today. So if you wanted to learn more about what that looks like, you could register for that.
Good plug. Sam, it sounds like your audio is operating fine. Do you want to try it out and I'll jump in if needed?
Yeah, sure. Okay, so I think we've done that question and we've got 4 minutes left. So I'm just going to highlight the next one. If one of the 4 could jump in and pick that up, that would be great. Thanks.
Okay, can everyone see that?
Yeah, I would say with this, like the best thing to do, the probably most reliable thing to do is if you are doing it where it's kind of just a finger in the air and just almost like a...
I'll jump on this one because it's hugely important. And
shall I carry on?
You go for it, Locky. Sandy, we'll come back to you next if that's okay.
Yeah, so what I was going to say is obviously it can look like a bit of a stab in the dark, especially if you're at this very early stage where you don't have any sort of background or history to sort of draw off and predict your future finances. So when it's in this very early stage, the best thing to do is just model off somebody else's similar business. So if you were going for a social media company, look at what Facebook did in their first 5 years, look at Instagram, look at Twitter, look at a variety of different similar businesses and use that to draw out your own numbers. And then when you're actually pitching this to or showcasing it to any sort of potential investors, tell them that, because it then shows that you've actually thought about it properly and you're not just going, I don't know, 5 million in 3 years. That sounds pretty cool. It just showcases that you've thought about it thoroughly. And that's also quite a key thing when you're going to any sort of pitch, is that you are thinking about all these different aspects in a very logical way, and it helps them buy into the team and add credibility to you guys.
Thanks, Locky. Sandy, I don't know whether you've dropped off now. It's possible. I guess just a quick question, follow-up question as well. How is it affected by COVID at the moment? So I've come across a lot of businesses that, really finger in the air. It was like that kind of pre-pandemic. Now it's kind of month by month, 6 monthly projections. Has that affected that in particular for anyone on the call? Russell shaking of the head. It's a tricky question to answer, Pete.
Yeah.
I guess for me, it's about the assumptions that underlie the numbers rather than the numbers themselves.
Yeah.
And if you build a good structured forecasting model, and we accept that these are all projections, they're all best guess estimates. But if you can spell out the assumptions that underlie those estimates, so I hate it when people come to me and say, well, there's the addressable market is 3 million, and if we can get to 10% of 3 million, that's 300,000. So that's what we're going to do. They don't talk about how that's built up. They don't talk about the assumptions underlying how they can get to 10% of that total addressable market. And they don't talk about the costs per customer acquisition and all of those kind of nitty-gritty nuts and bolts that we need to get down to the granular level. You need to get that level of granularity so that when you present your shiny charts, because that's what investors are going to want to look at, they can ask you, well, where do you get to that number? And you ask the question about, is it different pre and post COVID? Yes, it's probably more difficult to forecast. It's maybe more difficult to point your finger and say, well, he's done that, therefore I think I can do at least as well. But you can still build the assumptions, and a good investor, whether it's an institutional investor or a private investor, will look at those assumptions. We'll do a bit of a sense check. We'll do a bit of a reality check, or bring in an analyst to do it for you, and say, okay, well, if you only achieve 70% of your sales volume targets, what do your numbers look like then? If you only achieve 70% of your sales price target, what do your numbers look like then? If your costs escalate by 20%, what does that look like? And they can play numerical games with your assumptions to test the robustness of the outcomes and to determine the risk profile.
Thanks, Russell. That's really useful. Victoria, were you going to add something?
Actually, I think Sandy's back. So I just wondered, are you there, Sandy? No, I think she.
Yeah, I'm hoping I am.
Yes.
I am here, but on a massive delay. I'm in another time zone, it seems, today. I don't know what's caused that, but it is. This question I particularly wanted to answer because this is absolutely critical to everything that we look at when we're talking to a potential investee. And I would argue that you should have a very good idea about what your cost figures are, certainly for the next 12 months. And that should be the basis of your model. When we're doing early stage investing, we would want to be confident that the amount that we were investing would give a cash runway for at least 12 months. And in an early stage business, I can guarantee you won't hit your revenue forecasts in the first 12 months. So we really want to understand what your expenditure lines are looking like for the first 12 months and whether we're investing the right amount of money to give you a good enough runway to hit your milestones. Then back to Russell's point, with your revenue forecasts, you should be able to know your assumptions, how that is built up, and how that will go forward for you. And we will sensitize those revenue forecasts because we always know that they will be delayed or they won't be hit. But we need to understand that to know, we do enough early stage investing. We already know that. We're not going to hammer you for that, but we need to know that the money we're putting in is going to be well used and move you to a value inflection point over the next 12 to 18 months, ideally.
Sandy, thanks very much for that. And appreciate you dealing with the delay. I was worried that we wouldn't get to hear your point because you said this is the most important point and then kind of dropped off. So I think we were all worried about missing out there, but it was great that you could share that. I'm not sure that Sam is.
I'm here. Can you hear me?
Yeah. Sam, would you care to wrap up?
Yeah, well, I would actually, and thank you, and apologize. The internet's having a bad day today. I would just like to give someone called Daniel Whitston a couple of minutes to talk about a grant funding opportunity that some people or participants might be eligible for. So I don't know if Daniel, if you can unmute yourself and just take a couple of minutes to talk about this new fund from UFI, please.
Hi everyone, thanks very much for that, Sam. And hello, Russell. It's been a while since I've seen you face to face. Nice to see a friendly face here.
Hey, Daniel.
Yes, just really briefly. Basically, I represent an investment fund called UFI. We give out free money, grants that don't take any IP, that don't require any match funding. It's our seed funding round until February the 11th right now. We offer up to £50,000 a project, and it's purely in the area of educational technology in the workplace. So that is a specialist focus that our fund has, but we have a very, very broad approach to what is relevant for us. in terms of technology, we fund everything from, I mean, it doesn't have to be technology, but it has to be technology so it can scale up, is what I mean to say. So that tends to mean people can come with apps, they could come with something quite innovative to do with augmented reality or blockchain or anything at all. But as long as it's to do with training people in the workplace, employability, skills, something of that nature, and that's a very broad school. If you can pivot towards that, whatever your area of operation might be, if you have an idea, a product, a spin-off, a new angle you could take that's around your core offering that's to do with helping people do their jobs better, access employment, become more productive, learn things, whatever the technology might be, then you might be for us. It's open call. Anybody at all can apply. You don't even need to be a company. You could be an individual person with a good idea. You need to incorporate to receive the funds, but we do fund individuals who have a vision, and then kind of seek out collaborators to plug whatever gaps they have. So it could just be someone with an idea who then partners up with a technology company and perhaps an expert or some kind of content person. But it's very flexible. It could be a large organization that has a small innovation idea they'd like to try that they can't commercially fund. So, for example, we funded Jaguar Land Rover in the past, or as I said, we funded individuals. It could be a really small startup. It could be a university. It could be absolutely anybody. So we try and be as broad and as open as we can, and we have a very diverse spread of applicants. And that's essentially it. So if anybody's interested in learning more, then the website is ufi.co.uk. If you just Google UFI Seed Round 2021 or something like that, you would get there. Sam also has the details. I'll put a link in the chat afterwards to everybody. And I would just urge anyone who thinks it might possibly be relevant to have a look, maybe spread the news amongst your networks, because again, just to conclude quickly, the key thing that we like to avoid is just having the same old people apply all the time. People who are innovation insiders, people who are educators particularly, they're all welcome, but we want to reach regular people, businesses, entrepreneurs, people with ideas that they can't get funding for in the market, who could use 50 grand to build a prototype or a minimum viable product, get something out there. And we invest, we like risk, we like to try new things, we're trying to fund things the market isn't funding. So if it's somewhat challenging, no one's tried it before, and it's for a group of people that aren't getting support from that kind of thing, all the better. So that's it. Thank you very much for giving me the opportunity, Sam. Appreciate it. And I'll put the link in the chat. So thanks very much.
Thank you, Daniel. Pleasure. Hopefully everyone can still hear me. Feels like we've come to a natural conclusion. So thank you to the 4 panel members. It was great having you on board. Despite the challenges, hopefully the audience got something from this.